Hi there, Tara Lloyd from Fairway Independent Mortgage Company on mortgage insurance. What is it? Why do I need it? When can I stop paying it? So this will be just kind of a quick 101 breakdown of mortgage insurance. And of course, if you have questions, get a hold of me. So really quick, what is mortgage insurance? Just a high-level definition, it is an insurance policy on your loan for your lender in case you do not make your payments and go into default. So obviously, because it's in regard to whether you're going to pay your mortgage or not, mortgage insurance rates are determined based on your risk factors as a borrower. So your main risk factors that are weighted by mortgage insurance are your loan to value ratio, how much you're borrowing against your home versus how much you're putting down in your own cash, and your debt to income ratio, how much money you make versus how much money you're liable for paying each month, and your credit score, which is actually your credit score weights extremely heavily on mortgage insurance and can make a huge difference in how much you pay. So, why do I need it? Obviously it's not something that really benefits you in your pocket necessarily, but you need it because it enables you to purchase a home for less than 20% of a down payment. So that's kind of cool. It makes it a little bit more possible for people to come in with 3 and 5 and 10% down versus that huge chunk of 20%. So that's a major benefiting factor of mortgage insurance. What are my options? There are multiple options for mortgage insurance. And on every loan that I do at least 3 to 5 mortgage insurance quotes, because usually there's a few dollar a month difference in the payment, and sometimes the difference in the monthly payment can be pretty significant depending on the file. So it's super important to get multiple opinions on what your rates are going to be for that. So outside of conventional loans and also some other conventional programs that offer lower mortgage insurance requirements are things like the Home Ready and Home Possible programs. They just require less coverage for you, so that makes your rates cheaper. And then there are USDA and FHA programs, which have standard lower mortgage insurance rates. USDA is 0.35 for a monthly payment of the 0.35% of the loan amount, and FHA is 0.85%. So obviously those are good options if you have lower credit and not a huge down payment and you're trying to make something work. And side note on the FHA loans, it's important to recognize that while your monthly payment will be lower, and a lot of times this is just kind of the only way that you can really get your foot in the door and purchase a house, you will be stuck with FHA mortgage insurance throughout the life of the loan, unless you refinance it off or sell your home. So other ways to get around that, so we're talking about if you're already paying a mortgage insurance now. What do I do now that I'm paying it? I've been paying it for a while, I'm sick of it, how do I get it off? So standard mortgage insurance automatically falls off of your loan at 78% loan to value. And this is pretty typical almost across the board, so that's something that you can mostly rely on. Now, that sounds good, but keep in mind that that's based on your original loan to value ratio. So how much you purchased the home for originally and not how much it's worth now. That means that you based on your amortization schedule, if you look at that, that will tell you when your principal on your loan will be down below 80%, and that'll tell you when your mortgage insurance will automatically fall off. Usually it's quite a ways in the future. So if you have a significant mortgage insurance payment, a lot of times it makes sense to go ahead and refinance that off beforehand. Or the third option, which it does not require a refinance, is if you feel like your home values have gone up and you've been in your home for at least 2 years, you've made 24 payments on your mortgage insurance policy, and all of the 24 payments that you've made on your mortgage have been on time. At that point, you can typically start a process with your lender directly to request that to be removed. And that will require you to pay for an appraisal out of pocket, and that appraisal will have to support the value that your home value has risen to above that point. And then at that point, you can get that taken off. So that's a nice option as well. So those are some basic notes about mortgage insurance. If you're curious to see if you can get your high mortgage insurance payment taken off of your loan, if it balances out to make sense to where you can still pay for closing costs on a refinance and it will save you money, then get a hold of me and I can run those figures for you and let you know. If you are in an FHA loan and you've been paying on mortgage insurance for a while now, and you think your home values have gone up enough to be able to do a refinance, let's take a look at that, because sometimes that can save you a lot of money. And if you have any questions about mortgage insurance or anything else loan related in general, please reach out. I hope this is helpful, and good luck to everyone out there, and talk to you next time.